So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to answer the question, what's the difference between an iron butterfly and an iron condor? So structurally, there's only one real difference between these strategies, and I'm not going to get into the basics or to the pricing principles between them or how they interact in different markets. But as far as how they're structured and how they're built, iron butterflies are different than iron condors in that iron butterflies have the exact same short strike on both the call and put side. And iron condors, on the other hand, have different short strikes for calls and puts. So for example, if we have a stock trading at $100, the iron butterfly strategy might sell the 100 strike call and the 100 strike put option, and then buy options out on either end, say at 105 on the call side and 95 on the put side. An iron condor, on the other hand, might sell the 99 strike put and sell the 101 strike call option, so not the same strike, and then similarly buy the same 105 call and 95 put option. So you'll notice that the iron butterfly and the iron condor could conceivably trade the same long strikes and could conceivably trade similar short strikes, but an iron butterfly trades the exact same inside short strikes and an iron condor trades different inside short strikes. If you think about them as actually their synthetic main components or original components being straddles and strangles, that's where you get those inside short strikes for iron butterflies and iron condors respectively. And a straddle is selling the same strike price at both the call and the put side. With a strangle, you're selling different strike prices on the call and the put side. So as always, hopefully this helps out. If you have any questions, let me know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.